and he's retweeting Mr. Yuppie, a Canadian precious metals dealer has suspended all metals shipments to the United States. What is going on? Now, I made this chart. It looks a little funny. Why? Because when you go back all the way to January 18th, 1980, Stock Charts does not have intraday pricing. All they have is the close. That's the data that they've got. So the open is 49.45, the high was 49.45, the low was 49.45, and the close was 49.45. And so it's just a single line. But what I wanted to show you, this was the previous high back in, so this is the close that people refer to back in 1980. That is the high. So from Peter Spina, silver closes at historic highs in London. Highest price close in history. Exceeds January 1980's prior record close of 49.45, and it closed at 49.68 rounded. Silver set to break intraday record highs from January 18, 1980. Chicago Board of Trade, $52.80. Hold my beer from Tim Hack. SLV iShares Silver Trust borrow fee now almost 12%. That was on October 8th. From Make Gold Great, 0 silver SLV shares left to borrow still, and the borrowing fee continues to melt up. Now 12.34% for those desperate shorts. Now I want to point out, as if you're short, you really hurt as the price goes up. The pain gets bigger and bigger and bigger, and it's leveraged. Now, normally, they're getting squeezed from two ends here. Normally, the borrow fee is around 0.5% here, maybe 1.5%. Lately, it's been increasing, and we're up to 2.5%, and then suddenly, 9%, 10%, 11%, 12.34% that they're paying, along with the losses that they're already experiencing. Now, where do they get these shares that they go short on? Because they sell them into the market. They don't own them. They borrow them, and they sell them. They borrow them from their broker, their brokerage house. Where does the brokerage house get them? They don't have a whole bunch of shares that they own, that they loan you. Anybody that has a margin-enabled trading account.
Short sellers borrow shares from brokers, often tied to margin accounts, and sell them, hoping to repurchase later at a lower price. Brokers may loan out shares deposited by clients, sometimes without explicit notice. If prices rise sharply, shorts are forced to buy back at losses and also pay high borrowing rates. The borrowing cost is effectively an interest charge that compounds. In the current environment, shorts are squeezed between rising silver prices and surging borrow fees, a dual pressure that magnifies risk.
The brokerage house has the right to go in and borrow your shares without telling you. So you may think that you own a share of stock, or that you own some of this SLV or GLD, but actually your shares have been borrowed and sold into the market. They're owed back. They're supposed to get paid back. But those short sellers are now experiencing the losses of the rising prices and, as a compounding effect, paying this interest on it. So it's going to be a very interesting thing. But what you see here is one candle after another that are up candles with higher and higher closes. A trend that may continue. Tim Hack again. I think the paper market is actually starting to disintegrate. If quoting interrupts, stops don't work for short sellers. So when they set a stop and then the quotes stop working, if there's a gap up and the short seller has limited their losses, it can skip that stop and continue on up. And it just stopped for 15 minutes straight. From Manico 64, IGCOM stopped quoting spot silver for 15 minutes. It said that the London bullion banks stopped quoting. It's now back on. Cracks are starting to show. From TF Metals Report, Turd Ferguson, a.k.a. Craig Hemke. It appears that we may be quickly approaching a moment of true historical significance. Spot silver is up $1.40, but the front month December 25 contract futures only up 20 cents as the backwardation rises to an unprecedented $1.12. You might pay close attention to this for the next few days.
The tension in silver markets reflects a growing divide between paper representations, ETFs, futures, and physical metal. A key signal is backwardation. Spot silver now commands a premium over futures contracts, a reversal of the usual structure. This means buyers want delivery now rather than later. Meanwhile, lease rates, the cost to borrow real metal, have spiked as physical supply tightens. Some analysts argue the paper side is under stress, unable to deliver when real demand takes priority.
Now, backwardation is when you're paying more for delivery today than sometime in the future in a futures contract. And that's where we're at. People want their silver and they want it now. And so that was on at 8:56 a.m. on October 9th. At 11:42, just a few hours later, Bob Coleman says, silver backwardation alert update, $2.50 difference between silver spot cash and silver December futures. So in that short time, it changed that much. Moving along, Hansa Czerny, if Canadian Precious Metals Exchange, an authorized Royal Canadian Mint distributor, is doing this, it could signal that something more serious is happening in the cross-border trade of physical precious metals. And he's retweeting Mr. Yuppie. A Canadian precious metals dealer has suspended all metals shipments to the United States. What is going on? Now, I made this chart. It looks a little funny. Why? Because when you go back all the way to January 18th, 1980, Stock Charts does not have intraday pricing. All they have is the close. That's the data that they've got. So the open is 49.45, the high was 49.45, the low was 49.45, and the close was 49.45. And so it's just a single line. But what I wanted to show you, this was the previous high so this is the close that people refer to back in 1980. That is the high. So from Peter Spina, silver closes at historic highs in London. Highest price close in history. Exceeds January 1980's prior record close of 49.45, and it closed at 49.68 rounded. Silver set to break intraday record highs from January 18, 1980. Chicago Board of Trade, $52.80.
The current surge pushes silver beyond long-standing resistance zones. Technical charts point to the completion of a decades-long cup and handle formation dating back to 1980. That breakout could pave a path toward much higher levels. Yet caution is warranted. Recent candlestick patterns show signs of reversal. Shooting stars and intraday gaps hint that volatility is intensifying. At the same time, margin requirements on futures were recently raised sharply, straining leveraged positions and potentially triggering forced sales.
And so I made this chart just a little while ago. This goes back to Monday before last. And when you're looking at these candles, for anybody that doesn't know how to read them, the fat part, when it's a hollow body candle like this, the fat part at the bottom is the open. And then the intraday price action as things are going up and down is the wicks that might stick out of both ends, maybe not like this candle. And then the close is up at the top of the fat portion of the body. A black candle, this was the open, the intraday, and then the close is at the bottom. So Monday, Tuesday, Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, boom! And then something happened. Something changed, and the price fell dramatically and closed below its open. However, the close was still above the previous day's close. So based on a closing basis, this is still continued an uptrend. But this is, I think it's called a shooting star. It's a bad omen. It's technically it's supposed to not be a good sign. However, since it closed above its previous close, it's still an uptrend. and it doesn't matter. And when everybody looks at this, they scream, manipulation. It's got to be manipulation. Well, in this case, it was, and I think I've got some evidence here. I think what happened. So, Bob Coleman, CME margin increase alert. COMEX increases margin requirement for gold 5.8% and silver 9.3%. So, what I believe happened is it opened and it just started, it may have fallen a little and then starts taking off like a rocket. And right about there, they announced the change in margin requirements. What does that do to all the people that are holding futures, which is where the spot price is derived by the paper market?
Even as raw silver, door bars, flows toward refineries, those processors are backed up, often weeks behind, unable to turn metal into deliverable bars quickly enough. This bottleneck constrains available inventory for physical delivery. Simultaneously, mints and dealers globally report shortages, with premiums rising in places like India, where silver is trading at 10% over international prices. The backlog reveals a choke point. Demand is outrunning not just mining, but refining capacity as well.
And so all these people that are gambling on the commodities exchange, they've got these highly leveraged positions, and then they get a margin requirement, which is basically a margin call. They either have to cough up that cash or sell part of their position. And so it causes selling pressure. So if they announce it there, people were selling and selling and selling, and then the market closed there. And that avoids forced liquidation. Tomorrow, if they haven't coughed up the cash or sold part of their position, the brokerage house will do it for them and keep whatever they need to keep. But it doesn't matter. This is the 45-year cup and handle that I was the first one to identify. Everybody, including me, we were all focused on this cup and handle that had happened from 2012 until 2024. And then, I said when it breaks this resistance line here, we're going to have a slingshot move. And boy, has it been a slingshot from $25 to $49. It's huge. But what I wanted to show you is I tried my best. You can only move that blue line by 1 pixel at a time with the up and down arrows. And so I tried my best to get this on 49.45. 49.32 is as close as I could get it. The overlap, it doesn't really overlap because this line stopped at the pixel below this line. Anyway, it shows that there's a little gap there, and it looks like it's touching there. However, this is a linear chart where it's a constant percentage change. And so each inch of space on here is the same percentage change as the last inch of space. And it tends to compress all of the numbers at the top and expand the ones on the bottom. If you go to a linear chart, that is a constant amount of change instead of percentage of change.
We appear to be in a rare inflection. The structure of silver markets is shifting. As borrowing rates surge and backwardation intensifies, short squeezes could cascade. Many analysts now see silver at new all-time highs, with some forecasts targeting $65 or more by 2026. But the path upward won't be smooth. Liquidity strains, regulatory moves, or sudden reversals could provoke violent swings. For now, the core storyline remains. Physical scarcity is increasingly dictating price, not speculative paper flows.
And so that expands the bottom, expands the top, and we have this constant amount change. And now you can really see a gap there. We are way beyond the 2011 high at this point, and the tiny gap that's left is just a few pennies. And we have basically, at this point, completed the 45-year cup and handle that is predicting triple-digit silver. And I think it's going to be mid-triple digits. So from James Henry Anderson, good friend of mine, he was my the general manager of GoldSilver.com when we started out. And he says that Japan Bullion Market Association spokesman is this guy, Bruce Akamizu, hearing short squeeze in silver. Seems nobody's got silver in London, and lease rates skyrocketed 20 to 30% for short term if you're lucky enough to find a lender. Silver squeeze is on. Silver lease rates now much higher than that of platinum. So there is definitely a squeeze, and it is global. This is Eric Young again. Robert Gottlieb, quote, over-the-counter silver going to ETFs and India demand, basically no free-floating silver left. And Eric says, this is the first time ever I read Gottlieb write that there is basically no free-floating silver left. Robert Gottlieb is an ex-executive of J.P. Morgan Bullion Bank. This is the largest gold trader in the world, I believe. This is the J.P. Morgan Bullion Vault is right across the street from the Federal Reserve. There's these theories that there's a tunnel between them and stuff. It's a same number of stories below ground level. There's a reason for that. That's where you run into bedrock. But Dana Samuelson, friend of mine, great guy. Robert, why are lease rates sky high while refineries are backed up 4 weeks due to oversubmissions? It seems that there's a lot of physical, or is it just not enough 1,000-ounce bars to meet demand? And that's when Robert responded, OTC silver is going to ETFs in India demand, basically no free-floating silver left. Now, the free float is the stuff that's in the vaults, like at the London Bullion Exchange, or the stuff that's available for delivery. It's all gone. That's what he's saying. But what I want to point out here is inside Dana's question is something very interesting. He says the refineries are backed up 4 weeks due to oversubmissions. So there's lots of mine supply coming to market, Doré bars, which are impure, to the refineries. But the refineries are now the choke point. They can't process any more silver, so they can't meet any more demand than this. And that means that as long as there's more physical demand, that this is more upwards price pressure. If they can't refine silver at a rate that fills the demand, the price has to go up.